Hi everybody, this is the second lecture for topic 10. The first thing about this lecture is you are introduced to a new type of course. This course is called opportunity cost. Opportunity cost is the benefits that are foregone as a result of pursuing some course of action. Opportunity costs are not actual dollar outlays and are not recorded in the formal accounts of an organization. So let's see the example. So which of the following are opportunity costs of attending the university? So at one time, you have two options in your life: to go to the university or to work somewhere. So when you go to the university, what are the opportunity costs? What are the things that you have forgone, or the benefit that you have ignored? So let's see the options here. A, tuition fee, tuition. B, books. C, lost wages. D, not enough time for other interests. So what are the things that you have sacrificed when you go to university instead of working? So the answer is lost wages, isn't it? You go to university, you lost wages. If you work, you get wages. And another thing is not enough time for other interests. That one is cannot be measured in terms of dollar and cents, but lost wages can be measured using dollar and cents. Okay, so you will use that knowledge about opportunity cost in the later slides. Okay, let's see. This is the next thing. I think you have learned two type of decision making: add or drop segment and make or buy decision. So this is the next one. The next one is special order. Okay, special order is one-time order that is not considered part of the company's normal ongoing business. When analyzing a special order, only the incremental costs and benefits are relevant, since the existing fixed manufacturing overhead costs will not be affected by the order. They are not relevant. So special order is like this. Let's say you have a shop that sells cupcakes. Every day you sell your cupcakes at $5 per unit. So let's say at one day, somebody comes and said he wants to order 200 cupcakes at the price of $4 only. He asks you to put special ingredient in that cupcake. So that is an example of a special order. The order does not happen every day, and the order is unique. It always happens to many businesses. If you sell cupcakes, that the thing that I have mentioned can happen. Let's say if you sell, what else? I can think of another thing. You sell many things. Things can special order can happen to many businesses. Okay, so let's see the example here. Okay, this is an example related to special order. Jet Incorporated makes a single product whose normal selling price is $20 per unit. A foreign distributor offers to purchase 3,000 units for $10 per unit. This is a one-time order or special order that will not affect the company's regular business. Annual capacity is 10,000 units, but Jet Incorporated is currently producing and selling 5,000 units only. So let's see, is it so the decision that you have to make is to accept or not to accept the special order. If you look it without doing the analysis, you will see that here the normal selling price for the product is $20 per unit. The special order requested by the foreign distributor is $10 per unit. So if you do not do analysis, you will say that the company cannot accept the special order because it is the requested order is very cheap, $10 only. The normal price is 20. So let's see, do the analysis first, and then you can make a good decision. So this is the special order. So Jet Incorporated income statement. So the income statement is like this. See, revenue 5,000 times $20, because currently or now the Jet Incorporated only producing 5,000 units only. One unit the price is 20, so $100,000. So in this question, the variable costs are direct material 20,000, direct labor 5,000, manufacturing overhead 10,000, marketing cost 5,000, total variable cost is 40,000. So contribution margin is 60,000, fixed cost 28 and 20,000, so total fixed cost 48,000. So net operating income is 12,000. So this is the profit is related to the current operation of Jet Incorporated before accepting the order. Okay. So if the unit sales is 5,000 and the total variable cost is 40,000, so unit variable cost is $8. Why $8? $40,000 divided by 5,000 units, so you get the $8. So how to decide whether the special order should be accepted or not? So the way to do the analysis is like this. You compare the increase in revenue and the increase in cost if the company accept the order. So let's see. If the company accept the order, what is the increment in revenue? The number of the quantity of the special order is 3,000, and one unit, the price of the one unit for the special order is $10. So if the company accept the order, the increase in the revenue is 3,000 units times $10. So the increase in the revenue is 30,000. At the same time, the increase in cost is only 24,000. Why 24,000? Remember, we have calculated that unit variable cost for Jet Incorporated is $8, and the quantity special order is 3,000. So 3,000 times $8. The increment in cost is 24,000. So we can see here, if the company Jet Incorporated accept the special order, the total increment in revenue is higher compared to the total increment in cost. So this situation shows that it is a good idea to accept the order. So you can see here why the increment in cost is only 24,000. Only the variable cost will increase, because remember the definition of variable cost. The variable cost will increase when the quantity of production increase. Fixed cost will not increase, because fixed cost is fixed even though the quantity of production is changing. For this business, in this sample question, the capacity is 10,000 units. It means that Jet Incorporated can produce 10,000 units product. Now Jet Incorporated only producing 5,000 units only. So the company has idle capacity of 5,000. So the special order is only 3,000. It is within the idle capacity. So within the idle capacity, the fixed cost is fixed, is unchanged. So that's why here you can see that the incremental in revenue is 30,000, the incremental in cost is 24,000. So increase in net income is 6,000. So it is a good idea to accept this order. So let's see, there is another example related to this. So this is another example related to special order. Northern Optical ordinarily sells the X lens for $50. Okay, this business produce one product, X lens. The price of the product is $50. The variable production cost is $10. Fixed production cost is $18 per unit. And the variable selling cost is $1. The customer requested a special order for 10,000 units of X lens to be imprinted with the customer logo. This special order will not involve any selling cost. But Northern Optical will have to purchase an imprinting machine for 50,000. Okay, let's see how to answer this question. What is the question and how to answer it? What is the minimum price which Northern Optical should not go in its negotiation with the customer? In other words, below what price will Northern Optical actually be losing money on the sales? Is there any ample idle capacity to fulfill the order, and the imprinting machine has no further use after this order? There is ample idle capacity to fulfill the order, and the imprinting machine has no further use after this order. So when there is an idle capacity, you know that the fixed cost is unchanged. The fixed cost is unchanged, is fixed. So the only cost that is changing is the variable cost. And also the variable cost, only the production variable cost will change. Okay, see here. So the question is, below what price will Northern Optical will losing money on the sales? So let's see. So if the company accept the order, the variable production cost is $100,000, and then plus remember I told you the fixed cost is unchanged because it is within the idle capacity. And also here, after the variable cost of 100,000, the company has to pay additional fixed cost, which is the printing machine or something, 50,000. So if the company accept the order, the total relevant cost is 150,000. So unit for the special order is 10,000. So average cost per unit is $15. Why $15? 150,000 divided by $10,000, 10,000 units. So then the answer for this question is 15. The company cannot give price lower than 15. If the company giving price lower than 15 for the special order, then the company will make loss. 15 is the cost. Okay, I have to stop here, and then I will prepare lecture 3 for this topic.